Tom Lee, one of the most honest bulls in the market, just became more bullish. He went on CNBC and mentioned this.
I've underestimated how strong this market's been. I think it really shows macro data is becoming less important, and it's now the fact that a lot of cash has been on the sidelines. You know, for the last 2 years, investors expected a recession, or many thought when the curve uninverts, we got a recession, but at the end of the day, there's $6 trillion of cash on the sidelines, and October has turned out to be a great month.
We've seen it, evidence of what you're saying, and I know how closely you watch it. We've seen it on a daily basis over the last, I'd say, maybe month or so, where many days we're even down triple digits in the futures, only to end up 250 or 300 points by the end of the session. And with no backdrop of positive news, nothing to account for it, other than it seems like there's money on the sidelines that's coming in.
I mean, it feels like investors are underinvested in stocks. I think there's people who've dreaded 2024, thinking this is the year we slip into a recession, and instead, and we're seeing it with earnings, companies have been really resilient.
Yeah, we waited and waited and waited to retest the lows a couple of times in 2022 and 2023, and people weren't bullish at all. We didn't get great advances, and now it's almost unstoppable. And nothing seems to be able to knock it off a track, whether it's, I mean, I think the PPI and CPI were both a little hotter than people thought. The prospects for a Fed continued easing cycle are now open to some conjecture, I think, although most people say it's still going to happen, even though things are pretty solid in both the economy and the stock market.
Yeah. I mean, I think it makes sense for the Fed to be dovish just because inflation is still tracking, especially PCE, towards their 2% target. And now we have some concerns about the job market. So I think the Fed has to be supportive. And I think this election, which is becoming less of a coin toss, I think because it's been a coin toss, people have been sitting on their hands. I think these are reasons markets are starting to have conviction even in front of an election event.
We are a little bit over 2 weeks into October, and so far we are literally experiencing the opposite of what Tom Lee predicted. Tom Lee was essentially asked, hey, you've been wrong in October so far. Do you think it's going to get a lot worse in the second half going into November? Or is this volatility essentially canceled? And Tom Lee was very honest about his answer. Tom Lee basically came out and said he underestimated the strength of the market. Guys, he didn't fully grasp the market momentum, which is completely normal. Nobody can predict the market 100% of the time. And, props and kudos to Tom Lee for being honest about it. He admits that the momentum is so strong that no amount of bad macro activity is affecting the market's long-term destination. That's confirmation on what I've tried to teach you guys here on this channel, that as long as you have high quality companies, you don't need to worry about the macro factors since they're unpredictable anyways. Even when the macro factors are bad, the economy can do good. And when the macro factors are basically good, the economy can still do bad because it is a psychological game. It's herd behavior. And right now we're in a bullish market, which is fine. We want to make as much money as humanly possible. Get the wheelbarrow in, collect that cash, good, but also be cautious. Of course, you want to understand what's actually happening in the economy, what Tom Lee is saying. And he basically said there's a lot of side money going on. Basically, people are on the sidelines with their cash that are not investing yet. There's a lot of accommodation policies by the Fed, which creates a bull market despite red flags in the economy. They're accommodating the market. They're reducing interest rates, which is a really good thing for borrowing. And more borrowing means economic activity. More businesses are going to be borrowing money, more jobs, and jobs are very, very important to the economy. So listen, there's two sides of the coin, and this doesn't mean that we need to be buying call options and getting all crazy. We're in a bull market. That's part of it. We should have multiple different strategies that we're using right now, specifically with options, because that's what I'm doing. I'm selling options, but honestly, you can buy a little bit of options as well. You can buy bull call spreads on high quality companies with high momentum. And you can also be doing the poor man's covered call strategy, which is basically buying leaps and then selling calls against your leaps to generate income. So you could be doing long strategies like buying strategies because we're in a bullish market, but it's also important to be cautious when times are good because look, you want to rake in as much money as you can right now, but at the same time, you want to be a defensive investor over the long term. We are in an important period with elections. Lee believes that the 2024 election results, whether it's Trump or, Kamala, whichever one wins, that it won't significantly affect the stock market's performance. And I have to agree with that. Lee believes that in 2024 election, the results, whether it's Trump or Kamala Harris, whoever wins, he believes that the election won't significantly impact the stock market's performance. However, he notes that Bitcoin could benefit more if Trump wins due to his pro-Bitcoin stance. Now, I personally think this election will create increased volatility, but no directional move. At least no clear directional move. So look, the market is going to move up or down, right? It doesn't take a genius to figure that out, right? My comment section say, oh, wow, up or down. Yes, we all understand. We all want to know which way. That isn't possible. What is possible though, if you want to bet on both ways, you can actually buy a call option and a put option. That's called a straddle or a strangle, one of those two strategies. And if you purchase options on both ends, buying a call and buying a put, because times right now are unusually calm, I actually think buying options can be really interesting right now because the election cycle won't affect the market too much. But let's be honest, it's going to have an impact, right? We don't know which way. It could be a 6% winning month, or it could be a 6-7% losing month, right? So we're going to experience some volatility for sure. But what you want to be aware of is that since there's no direction, it is smart to hedge your portfolio. And it's also, I think, pretty smart to use a portion of your portfolio, 2 or 3%, to buy straddles. So here's what a straddle is. I'm going to show you an example. So we're going to jump into my portfolio right now. I'm going to show you what buying a straddle looks like and what buying a strangle also looks like. So they're both very, very similar strategies. And I actually get them mixed up a little bit myself because the definitions, they sound the same. They kind of look the same. So look, my portfolio is at $3.6 million. We've grown tremendously, guys. We've had phenomenal performance. So congratulations to all my Discord members, my one-on-one students as well. It's been a fantastic month. And yeah, things have been going really well. So look, I think if you want to hedge or bet on the straddle strategy, right, in election, what I would do is I would simply go to SPY. I would trade SPY, and then I'm going to look at buying a call and a put. So let's say that I'm going to go into December because I want to capture in all the November volatility. So let's go to December 20th, and I'm going to buy an at the money call and a put. Now listen, guys, I'm not an option buyer. I'm just showing you some examples of option trading strategies. You guys always ask what other strategies are you using. I mainly use the wheel strategy, but I get a lot of comments that you guys want something new. Here's something new. Here's something that is an interesting idea, but use it at your own risk, because buying options, if it doesn't end up going in your favor, you end up losing the money. So it's not a consistent income approach. It's more of a shorter term, higher risk, higher return approach, which nothing wrong with that. I mean, if you had good performance, I always tell my students, listen, some of you guys are making $20,000, $25,000 a month. Put 5K on a buy position. Why not? Have fun with it. I mean, if you're doing very well and you're exceeding all your goals, have some fun with it. Go for some buying strategies. Why not? It just depends on your personal risk level, right? And your risk tolerance and how much you want to budget out for consistent income and how much you want to budget out for taking a little bit more of a risky play. So here, this would be my risky capital. I would just go ahead and buy a 585 call. All right. So right here, you'll see that the upside is unlimited. So why not? Options are pretty fun. You get unlimited upside. Then I would also buy a put option for December, and I would just do 585. This is basically right at the money. And right here, you'll see it's a long straddle. It benefits from high volatility. By the way, there's a couple ways to make money here. There's a couple ways to close this position. So look, the first way is if SPY ends up rising, I mean, you can wait until expiration. It'll be somewhere in this zone. You're going to be in the green. Or let's say that before December 20, we have election, all that. It goes up a lot and you're somewhere in this zone and you still have time left. Just close out the trade. Same thing applies for the bottom. If the stock market ends up falling, SPY is at 500 or whatever, you're going to end up having like a ton of profit, right? If it's at 500, basically this option will be like $85 in the money and you've paid 29. So you can technically turn 29 into like 85 in this example. So that would be more than doubling your money, almost tripling your money actually. So, I mean, the rewards could be pretty significant if you have a huge move, which is possible. Nothing's impossible in this world, guys. Kind of two rules. Nothing's impossible and nothing's guaranteed. So a lot of stuff could happen. And we have a saying in Russian. It's like, who doesn't take the risk doesn't get to drink champagne. Something like, basically that's how it translates. So take a risk, drink the champagne. So 585 call, 585 put. I would do something like this. And this is a long straddle. Now, if you want to reduce the cost, which you can, so let me go back here. If you want to reduce the cost and say, actually, I'll show you 3 strategies in this video. It's going to be interesting. You can go for an out of the money. This will reduce your cost because you're going out of the money, right? So 590, it'll reduce your cost, and then 580. So this is going to be a long strangle. It's the same thing. It's the same thing. You know what the difference is? Instead of the same strike, the 585 2 times, now it's just like a little gap here. It's like the same thing. It's like a little line. It looks a little different, but it's about the same thing. So it's a straddle versus a strangle. A strangle is going to be a bit cheaper. So the cost here of this position is a bit cheaper because it's a little bit out of the money. Now, if you want to play the iron condor strategy, I think that could be really interesting as well. So if you go to sell call, right, we have a long call. So now we have a long call. We can sell calls as well. So we can sell, let's say we're going to do a $10 width, which I typically don't do, but I'm showing you something interesting here. All right, so let's go for a $10 width. So I'm going to go ahead and sell that. And then I'm also going to sell a put option here under, so I sold the 580, I'm going to go for 570. All right. So now this right here will basically be a kind of like an interesting iron condor play, pretty much. So here your total cost went down from 2.7K down to just 776. So this would be a much more suitable small account strategy that I think is also viable to play around with and potentially get a return. Here the return is, it's actually not that high because you're putting up a very small fraction of what you would be. But here your break evens are pretty close. I mean, if it's above 597.69, you're going to make some money, or if it's below 572, you're going to make some money. So if you think there's going to be volatility through election, which I think so, this could be a profitable play. Again, it's not my style, but it's a profitable play potentially. So look, while Lee remains bullish, he acknowledges potential risk, including oil price spikes from geopolitical conflicts or a poor earnings season, which could temporarily derail the market. Earnings are very important for the market, guys. Once there's a little bit of bad earnings, the whole market goes down because it's all herd behavior. So I would say, hedge, stay in high quality companies. My advice, not a financial advisor, but my advice here that I'm giving on YouTube as a coach doesn't change. Be in high quality companies, buy a little bit of options right now because it's interesting, and sell covered calls and sell puts and run the wheel and do some spreads. Typical stuff that I mentioned, guys, but I really want to point out that what Tom Lee is saying right now, that he was wrong, very admirable of him, and also very interesting because right now you'll see that in October, so far, everything's been smooth sailing. So it's going to be really interesting times right now going into November, going into election. And I've got more option strategy videos for you guys coming out this week. So please subscribe and let's wrap up October with a lot of profits. I'll see you guys tomorrow.